Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 157 on March the 13th, 2021. I'm your host, Eric. And in this week's show, we will cover the trades from last week on AMC Entertainment, the S&P 500 ETF, and the US Oil Fund ETF. And we discuss three new trades on SM Energy, JetBlue Airways, and Cameco Corporation. Now, it's always great to hear from listeners. If you have any questions about trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, I hate to sound like a broken record, but this week we hit new highs in the U.S. equity markets. The Dow Jones Industrial Average grew 1,282 points, ending the week at 32,778 points. The S&P 500 index rose 101 points, finishing at 3,943 points for the week. And now it's time to discuss the topic of the week. The topic of the week this week is the importance of looking at multiple time frames in your technical analysis. I use technical analysis when looking for, or at least analyzing, option trades. The trades presented on this show have a directional bias, meaning they are affected by movements in the underlying stock. And because of that, I want to be aware of any ongoing trends in the stock and any important support and resistance levels that may be reoccurring or ongoing. So using technical indicators to analyze the stock's price history is very valuable to me. Now, early in my career, I learned about a number of different techniques, like using moving averages and identifying chart patterns that are common, and some more, statistical ways of looking at price history. And it was sometime later that I began looking for confirmation using multiple time frames. When I started off in the past, I would only look at one time frame, like a daily chart. Typically, we were using daily charts. Now, I start with the daily chart, but I continue on to an hourly bar chart, a 30-minute bar chart, sometimes even a 15-minute and 5-minute or lower data is used. And many of the technical indicators that I mentioned earlier, like moving averages, they actually are lagging, which means that the indicator, it typically takes a couple of days of price action before the indicator itself will actually change direction. So what if that's true on the daily, when you can shorten the time frame, you can also shorten the amount of that lag. So an indicator that was, say, 2 days behind on the daily charts becomes 2 hours behind on the hourly chart. And it's something that I found extremely helpful. And honestly, I hope that helps you too. I think when most of the technical indicators were created, a lot of these guys, in the we'll call it 50 years ago, they were using, charts that they created by hand. So you couldn't just go from, just suddenly use daily data. You could do monthly, like you could aggregate and take longer price averages, but you couldn't even, you really didn't even have easy access to tick data like we have today. Nowadays, like I use TradingView, you can hop on TradingView and get all the way down to 1 minute data. I mean, that data just didn't used to be available, but now because it is, it actually can help you in your analysis as you're looking for stock or underlying stocks that are trending. And then it's just a matter of discussing which option strategies are best, or which ones are work best for that trend or that direction in the market. So last week I added 2 videos to the videos tab of the weeklyoption.com website. The first video covers some of the basic option trading strategies that we discuss on this show. I really wanted to redo that 5 and 5 video series that I originally had, and So I redid that video. It's a little bit nicer. It's a longer video so that I could actually explain some of the strategies a little more thoroughly. And then I posted a second video that covers 3 technical analysis patterns that I use often. In fact, I create daily videos on technical analysis covering stock. I do cryptocurrency over the weekend, and sometimes I take a look at futures trades and occasionally Forex. You can watch the video on technical analysis that's on the website for a short tutorial, and you can also take a look at some of the other videos on the YouTube channel that I have for the Income Trading 101 channel. It's solely focused on technical analysis. So if you want to get a look at that, you can find that channel on YouTube and see what I'm creating on a daily basis. So, all right, let's get into the trade review from last week. Of course, we had all-time highs in the overall index. So you know that any strategies that benefit from prices going higher are going to will likely have improved this week. So we'll start off with the covered call. We looked at AMC Entertainment Holdings, symbol A as in Alpha, M as in Mike, C as in Charlie. This is one of the stocks that's been in the news lately, along with GameStop, for the Wall Street bets sort of portion of trading and data and increased volume. Now, when we looked at this, stock was trading for $8.05 a share, and I looked at buying stock and selling that March 8.5 call at 92 cents, hoping for a 17% return in 2 weeks. So this is a March option, and March expires next week. So AMC stock grew $3.11 this week, closing at $11.16 per share. The call option we sold gained $2.48, leaving us with a net profit of 63 cents if you were to close the trade early. And of course, you'll gain $1.37 total profit if you hold this trade through expiration, and the stock price currently remains higher than $8.50 per share. So there isn't a reason to close this trade early. This was a good trade. No adjustments are needed. And like I said, this was a March trade, so it expires this upcoming Friday on March the 19th. Our second trade from last week did not fare quite as well. This is a credit spread. We looked at the S&P 500 ETF, symbol S as in Sierra, P as in Papa, Y as in Yankee. At the time, the stock was trading for $383.63. I looked at selling the March 390 call spread at 36 cents, which could give us a maximum possible loss of 64 cents. Now, the Spiders ETF grew $10.43 over the week, closing at $394.06. The out-of-the-money call spread we sold is now in the money. You can repurchase the spread for 63 cents, marking a loss of 27 cents per spread. Now, I would typically look to sell a lower strike put spread against this to recoup some of the value and turn this into an iron condor. Now, you could sell the March 388 put spread at 25 cents, which would lower your current loss to 2 cents. However, this upcoming week, of course, is options expiration, so it's likely that the call spread we sold will remain in the money. Therefore, I would simply exit the trade and take the loss. I wouldn't sell the put spread on its own because the value just isn't justified. And let's do some math. If I simply keep the short call spread, I've already lost 27 cents on the spread, and I could potentially lose another 37 cents because the spread will likely be worth $1 at expiration, which is 5 days away. If prices remain high and I sell the lower strike put spread to create the iron condor, I would take in 25 cents today, which is great. That reduces my loss to 2 cents. However, the call spread is still expected to expire being worth $1, so I could still lose another 39 cents on the trade. If I close the call spread and then sell the put spread against it, I could lose even more money if prices change direction and the put spread ends up finishing in the money. I'm always looking to either lock in profit or limit loss, and given that we're only 1 week away from expiration, I think closing the trade and assuming the 27-cent loss would be the best bet. Sometimes adding to the trade and changing the risk works, But in this scenario, each of the scenarios leads to me ultimately losing more money than I've already lost this week. I would actually go ahead and take the 27-cent loss because that seems to be the lowest loss that's going to be likely for any trade that I do with this one. And then our final trade from last week was a debit spread on the United States Oil Fund ETF, symbol U as in uniform, S as in Sierra, and O as in Oscar, USO. At the time, the stock was trading for $44.44, and I bought the March 43.44 call spread for 68 cents, which can give us a maximum gain of 32 cents or a 47% return in 2 weeks. Well, USO shares finished the week at $44.35 per share, which was 9 cents lower. Our in-the-money call spread we bought is still in the money by a full 35 cents per share. And the spread can be closed for a gain of a whole 2 cents if you were to sell it right now. But there's no reason to sell it because of where prices are. If prices remain above $44, we lock in a 32-cent gain on the week, marking a 47% return on capital, right? Our break-even price for this trade was $43.68. So right now, we are still, what would that be, 67 cents in the money, 67 cents above our break-even. So it's highly likely right now that this stock is going to finish above $44 per share. But the main thing that you have to do is be aware of the break-even price and just manage your position over the next 5 days. Because if this stock expires higher than $44 per share, then we're going to make the full 32 cents on our option spread. Because the spread will if it's in the money, it's going to be worth $1 at the end of the week. So no adjustments are needed at this point. Now, this upcoming week, of course, I've mentioned it is expiration for March options. These new trades will move. We're going to be moving into the April expiration trades. So I'll be using monthly options that expire on April 16th. And to that matter, last week I asked, I thanked you guys for listening. That we're 3 years into this show. Thank you so much for following along with me on this journey. And I asked, I got some great suggestions via email. Some of them are easier to add to the show than others. Some are easier to add to the website than others. But I just wanted to thank you guys, everyone that did send an email and give a suggestion. I received it, and I'm hoping to add a new, hoping to alter the show a little bit starting next week. So for this week, we're going to keep to the normal sort of strategy of giving a covered call, a credit spread, and a debit spread. So let's start off with that covered call. I'm looking at SM Energy, symbol S as in Sierra, M as in Mike. The stock ended the week at $18.88 per share. I'm looking at buying that stock and selling the April 20 call at $2.10, which can give us a maximum return of 17% in 5 weeks. Now, you enter this trade by buying SM stock for $18.88 per share and selling the April 20 call at $2.10. This trade makes the most money if stock prices finish above $20 per share, and the break-even price is $16.78 per share. In real terms, the stock purchase will require $1,888, and you would collect $210 for selling the option. Our next trade on the week is going to be a credit spread. This week I'm looking at JetBlue Airways, symbol J as in Juliet, B as in Bravo, L as in Lima, U as in Uniform. The stock ended the week at $20.43 per share. I'm looking at selling the April 2019 put spread at 37 cents, which could give us a maximum possible loss of 63 cents per spread. Now, you enter this trade by selling the April 20 put at $1.04 and concurrently buying the April 19 put for 67 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices stay above $20 per share. The break-even price on this trade is $19.63 per share. In real terms, you'll collect $37 per spread that you sell and have $63 at risk. Our final trade on the week is a debit spread. I'm looking at Cameco Corporation, symbol C as in Charlie, C as in Charlie, J as in Juliet. The stock ended the week at $17.24 per share. I'm looking at buying the April 16-17 call spread for 65 cents, which could give us a maximum gain of 35 cents or 53.85% return in 5 weeks. Now you entered this trade by buying the April 16 call for $2.03 and concurrently selling the April 17 call at $1.38. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay above $17 per share. The break-even price on this trade is $16.65 per share. In real terms, you'll pay $65 to enter this spread, and your maximum gain is $35 per spread. So that's it for this week's trades. Thank you guys so much for listening. As I said, feel free to email me if you have any suggestions or comments on the show, or even if you have any questions. I do answer my emails personally, so some weeks it takes me a little longer to reach out than others, but thanks again for listening. Thank you for sharing the show with your friends, and feel free to continue sharing. And as always, happy trading.
Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.